Investing, stocks versus books. The pros and cons to equities and books as investing vehicles. And to christen it off, I got to give the gematria. Stocks and books are investments equals 333 English ordinal. We know the number. That's powerful. So we know we're in the right place. Stocks and books, those are great ends, bookends, pun intended, of how to make money and how to span generations investment wise. Some key considerations before really getting into it. Investment goals. Are you prioritizing growth and liquidity, or is the value of tangible assets in niche markets important to you? So do you want growth and liquidity so you can get in and out and you have a higher chance of growth? Or do you like tangible assets that you can touch, and that you're not probably going to lose a whole lot of money on them? And do you like niche markets? Do you like a story behind it, per se? Time commitment. It's another consideration. How active do you want to be in your wealth accumulation? Your risk tolerance. Can you handle volatile markets and prices? And passion versus profit. You want to balance out financial gain with the love of the game, right? So you got to balance that out. These are all key considerations people need to look at when investing in stocks or books. So let's talk about the pros to stocks. Liquidity. Stocks can often be bought and sold quickly, providing easy access to cash. There's a potential for high return. With the right investments, stocks can offer significant appreciation and dividend payouts over time. We went over super investors, average backgrounds. A lot of those investors have dividend paying companies that they've held for decades. And if you allow those to appreciate, man, you're going to have an explosion of money at the tail end of all of that. It's like a snowball rolling down the hill. It just gets bigger and faster and bigger as it continues to roll down. Diverse opportunities. You can diverse across industries, geographies, and risk levels to minimize potential losses. So, diversity is very important in the stock market if you want to limit your risks and limit your losses. Okay. You can buy a couple shares of one stock in one industry, in another. You can do international. You can do bonds. You can do ETFs. There's a lot of creative ways to procure a stock portfolio to your liking. There's passive management options as well. Index funds and ETFs allow for hands-off investing while still participating in the market growth, right? You could just what's the word for it? Outsource the active investment part. Give it to the people who went to school, who have a lot more experience in it with these ETFs, hedge funds, and such. And you just want to see your money grow over time. It's not going to be as large if you are active yourself and doing it yourself, but you'll still get that long-term trajectory up. And you don't have to worry about it, and you can go about your life and live it. And a lot of people love doing that. They want to live their life, but they want to make sure they're doing the right things with their money. And the positive to stocks, what people love, is the growth potential. Historically, stock markets tend to grow over time in the long term, making them attractive for wealth building. In the long term, especially in America, Warren Buffett has said, always bet on America. They grow over the long term. If it's a good company, it's going to be able to survive and thrive in any era, recession, depression. If the stock price goes down, that could be a potential opportunity to buy if it's the right company. And another thing is transparent pricing, especially in the new age world with all these different brokers, you know, uh, right on the spot listing prices. Stock prices are publicly available and regulated, making it easier to understand the market value. You know, you can go on your phone and you can see different listing prices for thousands of different companies. And a lot of them have great liquidity, so you can get in and out relatively easy. You know, you don't have to price it yourself. The market already prices it for you. The power of compounding, investing in good businesses that compound over time will increase returns exponentially. That's you know, an absolute over time. Even if a stock is down for a little bit, but if it's a good company, it always comes back. It's just that is what it is, you know, and that spans hundreds of years of human history with financials, right? So good businesses over time always work themselves out. There has not been many examples where that hasn't happened. If you're a good business, you're going to grow. Now there might be better businesses out there that grow higher, faster, but if you're a good business, you'll get some type of return in the long term. And ease of scaling. Easy to scale investing business with pure money. And we'll get into that example when we start getting in books, right? Since it's just cash, it's in a brokerage and it's in a larger business, you know, it's easier to park money there and allow it to grow. A lot of times, depending on the business or investment vehicle, it's not that easy to scale, right? If you're in real estate, you have $10 million, you know, you could, you know, buy $10 million houses, which comes with a whole different other host of problems. You could buy a house for $10 million, which is one, but then the liquidity's messed up. You know, you can't buy $10 million worth of real estate that day on a house and sell it tomorrow. It's not how it works. You can do that, especially in the modern age in the stock market. And I just want to bring up some history, an example. The Bank of New York Mellon Corporation, BK or BNY Mellon, has been listed on the NYSE, the New York Stock Exchange, the longest. It also has the second oldest company listed in NYSE. Its predecessor, the Bank of New York, was founded in 1784 by Alexander Hamilton. The Bank of New York was the first company to be publicly traded on the NYSE in 1972. BNY Mellon was created through a merger in 2007. So, I mean, that's over a 200-year-old company. That's almost, I mean, that's as old as America, essentially, almost as old as America. And so you see, there's a lot of longevity in that. And if it's a great company, it's long lasting. Imagine how many generations that could help, right, in your family line. So these are really things to think about. These are the pros to stocks. The cons to stocks: volatility. Stocks can experience significant short-term fluctuations, potentially leading to losses. Obviously, if you're in the stock market, the prices are going to go up and go down, and you have to stay the course. You have to stay the course. If you get scared and you sell out, you know, maybe stocks aren't for you. That's a con. Maybe you need something a little bit less volatile. Market dependency. Stock performance is influenced by economic, political, and market-specific events. You know, some other investment vehicles, they're not affected as much as stocks are with the outer world, right? So you have to understand that. And there is a knowledge requirement. Successful stock investing often requires research, market knowledge, and professional advice. You have to do the work if you want to be good at stocks. Even if you want a passive income investment vehicle like ETFs or a fund, you have to research the fund to make sure you're putting it in the right place. So you have to, you know, do a little bit of digging and knowledge. There's also a potential for loss, but there's a potential for loss in all investments. Investments can lose value if companies underperform or markets decline. That's the risk we take. And another con is psychological stress. The ups and downs of the market can cause stress, especially for short-term investors. That's why it's important to never invest more than that you're willing to lose. Because if you invest more that you're willing to lose, you're going to be having some nights where you're not going to be able to sleep. The goal is to be able to invest, but also sleep well at night, regardless of what happens. That's the goal. And so the average lifespan of companies listed in standard S&P 500 was 61 years in 1958. Today is less than 18 years. McKinsey believes in 2027, 75% of the companies currently quoted on the S&P 500 will have disappeared. And so that is a thing to think about. You know, the companies aren't going to be listed on the S&P 500 forever. It's a different time. So that's why you have to be able to understand what companies you're invested in. It's not as long as it used to be, at least for the S&P 500. So to get those long-term compound interest, you got to be able to withstand that if it gets dropped off the S&P, if it stays on the S&P. With a lot of technology companies today, it just causes a lot of volatility. So, you know, stocks does not come without negatives. That's very important to understand. But the positives way outweigh the negatives if you have a little bit of knowledge and you're willing to wait it out.